time is up for some of the cheapest money on record, just as life is becoming more and more expensive.
The FOMC raised its policy interest rate by 1/4 percentage point.
It's just a fraction, but the US Federal Reserve raising its benchmark interest rate for the first time in more than 3 years has global ramifications, from the cost of mortgages to the value of the dollar.
By raising its benchmark interest rate, the Federal Reserve is bringing an era of ultra-low borrowing to an end. But by keeping that rate so low for so long, it's been blamed for inadvertently ushering a new era of surging inflation.
US inflation is running at nearly 8% for consumer goods, partly driven by a mix of pent-up consumer demand and government stimulus related to the pandemic. But wholesale gasoline prices alone surged 14.8% in February, and the West's embargo on Russian oil and gas over its attack on Ukraine is driving fuel costs even higher. That's left the Fed with virtually no choice other than to hike that benchmark rate to rein in inflation, while answering critics who say it's too little, too late.
Higher energy prices are driving up overall inflation. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine will put additional upward pressure on near-term inflation here at home.
But others say raising that rate too fast threatens to tip an economy that's been booming after the worst of COVID-19 into recession. Owen, Fairclough, CGTN, Washington.